While war costs are often measured in destroyed hardware, Russia's most severe deficit is currently human. It is a movement of human capital that is draining the country's productivity from the inside. Take a young software developer leaving Moscow for Tbilisi, Georgia. This single departure represents a broader demographic trend, a high-skilled specialist taking their talent and their future elsewhere. This is a reversal of a 20-year state project. Russia invested heavily in its tech and engineering sectors, specifically to diversify the economy away from a reliance on oil and gas exports. The scale of the 2022 exodus is significant. Roughly 1 million citizens fled the country, and data from the French Institute of International Relations shows that 86% were under the age of 45, with 80% holding a college degree. The departure of these specialists has created a structural crisis. It removes the specialized labor required to sustain the non-military sectors the government spent 2 decades trying to build. Economists track the value of a worker through the GDP multiplier. A high-skilled employee does not work in isolation. Their income supports an ecosystem of secondary activity. A single high-earning worker drives demand in the civilian economy. They rent apartments, spend at local businesses, and pay income taxes. Their salary effectively supports the jobs of the people providing those services. When that worker leaves, the multiplier runs in reverse. The housing, retail, and tax nodes lose the revenue that the single salary once generated. When this is repeated 1 million times, it creates a vacuum in the domestic market. This also resulted in a sudden drain of liquid wealth. In 2022 alone, Russia saw an estimated $42 billion in capital flight, as citizens transferred their personal savings into foreign bank accounts. This subtraction of capital and people contracts the civilian economy. It leaves the country with fewer high-yielding assets and accelerates a trend of reverse industrialization. We see this bleed in the bibliometric data. This chart tracks the net migration rate per 100 researchers in Russia. Between 2022 and 2024, the red bars show a sharp decline, an annual loss of about 0.8% of active researchers. Looking at the outflow data, researcher departures peaked at nearly 2,000 in a single year. The fields hardest hit include the most internationally integrated disciplines, such as physics, mathematics, and computer science. The Russian central bank has officially acknowledged the scale of this crisis. Governor Elvira Nabiullina warned that the economy is facing a historic labor shortage, with unemployment falling to just 2%. While low unemployment is usually a sign of health, here it indicates an exhausted labor pool. Companies are competing for a shrinking number of workers, which drives up wages and inflation without increasing actual productivity. Data from the Sberbank tax registry shows the impact on the private sector. Civilian business closures have risen to between 12,000 and 15,000 per month, marking what analysts call a full-scale demographic crisis for Russian firms. The labor pool is being drained by the state. The military-industrial complex is outbidding civilian companies for the remaining workers, offering massive signing bonuses to fill a shortfall of 160,000 specialists. By prioritizing military production amidst this shortage, the wartime economy is forced to use its civilian resources to sustain the current conflict. The human capital and wealth exiting the country relocated across the border, triggering a wealth transfer to neighboring states. Cities like Tbilisi have seen a large influx of software developers and capital. In Georgia, the estimated number of software developers grew by 94%, while Armenia saw an increase of 42%. This relocation has shifted the relative economic output of the region, leading to a historic data point recorded by the IMF in 2025. This chart tracks GDP per capita. In 2025, Kazakhstan's figure reached $14,770, officially crossing above Russia's $14,260. For the first time in modern history, Russia is no longer the per capita economic leader of its own regional trade bloc. It has been overtaken by its neighbor. The World Bank notes that the move of Russian capital and people has restructured the service and tech sectors of these host countries. This shift has altered the economic balance of the entire post-Soviet region. It leaves the state with a difficult reality. Has the state traded its long-term technological potential for a temporary gain in territory?